I'm Jesse Mackey, CIO of 4Thought Financial Group. And this is 4Thought's Market Perspective as of February 16th, 2021. Most stock types are outperforming bonds so far in 2021. U.S. small and mid-cap and emerging market stocks in particular have strongly surged past their U.S. large-cap counterparts this year in an upset of the dominant trend of the last several years. Back on November 9th of 2020, the S&P 500 index of U.S. large-cap stocks had fully recovered from its September 10.55% downward correction and had achieved a new record price. It has accumulated additional gains of about 7.92% since then, as of the close of business yesterday. Prior to this, the rapid recovery from the 2020 bear market low point on March 23rd, at which point the S&P 500 had dropped more than 34% from its previous peak, met our technical definition of a new bull market. Based on a new intraday price analysis study we recently conducted, historical data indicates that once a new bull market has been confirmed, which happened on August 18th, the shortest time period on record since 1950, before the beginning of another bear market, was only 6 days, and the longest time on record was approximately 7.44 years, with the average coming in at about 2.44 years. This differs from a prior closing price data analysis we had used in the past. Approximately 5.97 months have elapsed from the point of bull confirmation in this instance so far. We also note that there's usually been at least one 10% plus correction, but often several, between most bear markets in history. The average time between the end of one correction or bear market and the start of another is a little over 1 year. The first correction in the current bull market was completed about 4.73 months ago on September 24th. We like to refer to the combination of a correction and its corresponding recovery as a wolf market. Our data set also tells us that about 55% of wolf markets like the one we recently experienced have been followed by a period that exhibits trailing one-year returns of 30% or greater, something we refer to as an eagle market. For much of the remaining 45% of the time, we return to a plain old bull market. There are a limited number of historical instances of more negative immediate outcomes, but the periods immediately following a recovery from a correction have historically been mostly positive for stocks in the short to intermediate term. However, valuations from a probabilistic analysis perspective tell a story that's not nearly as positive. On this basis, stock types range from near fair value, such as with international developed market stocks, to moderately overvalued in the case of large cap growth stocks. Bond types range from near fair value in the case of emerging markets bonds to slightly overvalued in the case of Treasury inflation protected securities. Against this backdrop, the outlook for stocks is now neutral in the intermediate term based on the overall aggregate of our historical market type data analysis and quantitative probabilistic analysis. U.S. small cap stocks are the best performers so far in 2021, while U.S. aggregate bonds show the worst year-to-date performance. Emerging markets bonds now reflect the most attractive pricing relative to the alternatives, while U.S. large cap growth and tech stocks are the least attractive. With regards to allocations amongst investment methods, we're now allowing overweight allocations to selective concentrated investing, neutral allocations to strategic asset allocation, and underweights to liability-driven investing and opportunistic investing. I hope this was helpful. If you have questions, or you'd like to discuss what this means for your particular situation, please contact 4Thought at 516-300-1617 or at info@4tfg.com. And don't forget to subscribe to our blog feed and our YouTube channel. Thanks for watching, and see you next week.